Hello and welcome to Chapter 6 of the Accounting Insight series. This chapter deals with purchase invoices to be paid off. So if you remember from Chapter 2, you compiled a list of purchase invoices for goods and services that you purchased from various businesses. So in this chapter, we are going to follow the following steps to update this list, try to find out which suppliers have not yet been paid. So the first thing to do will be we're going to go through the bank checkbook stubs and use the information there to update our list of suppliers here with the amounts that we paid them. That would be step 2. And then we'll also look through the bank statement because there'll be some direct payments from the bank. We'll update the amounts we paid the supplier there. We'll then complete the outstanding column here. So this will need to change. In the case, because I'm using Excel, I've got a formula that will automatically calculate these amounts. If you're working with pen and paper, you need to use your calculator to calculate the outstanding amount. And then I'll explain a bit more about what it is we're seeing here and introduce some accounting terminology. So first thing is step 1. So we're going to go to our bank checkbooks, and if you remember, they are in the work pack appendix A. So here, checkbook stubs. So we'll go through each one of them. So the first one, £940 property rentals, was paid on the 9th of February. So we just update that here. So yeah, that's been paid. You can see the outstanding balance goes down to 0. Second one was Bits and Bytes, 15th February, so that would probably be the first one invoice from them. So that is 5875. The third one is Vanza Go, £1,000. So Vanza Go, yeah. There's a balance left there. The fourth one, In Case Insurance, £250. In Case Insurance, £250 we pay them. Balance 0. Fifth one, Bits and Bytes, 3,525. Bits and Bytes, I believe it's this one. And we pay them 3,525. And if you're not sure, normally the person paying the supplier will write a check number on their purchase invoice, so you can double check which purchase invoice it is they've paid. Sixth one is a Phone Call Limited, yeah, there, and we pay them the full amount, so that's 55.34. Scroll down a bit. And the seventh one is Vanza Go. Okay, we paid some more to them, so I'll put in here using my formula, 1,000 plus the second amount that we paid them. Yeah. The eighth one here is Cash Drawn, so that's not a supplier, so we didn't have an invoice for that. And this one is Motor Tax. I don't think we got, we don't have a supplier invoice for them listed, so those two don't go on here because they're paid directly before we had the purchase invoice. So normally a business is taking credit from its supplier, so you order the goods, take maybe 30 days or 3 months before it then pays off the supplier. If it's paying them straight away, like for example the motor tax, you don't really need to have a list of how much you owe the motor tax company or authority. You can just pay them straight out of the bank. So that's the difference between purchases that you get on credit. You really want to have them on your list of purchase invoices, trade creditors, and those that you're paying straight away, you're not taking any credit. You can just pay them straight out of the bank and debit your profit and loss, or your expense account rather. Okay, so that was the going through the checkbook stubs. We're now going to go through the bank statement, which is here. You scroll down, so it's the next page after that one. So we're going to look through some payments. So Solar Motor Fuels, we pay them 169. We have invoices from them here. So Solar Motor Fuels, yeah, 169, 169.20. That one we've entered, that one we've entered, that one we've entered. That is paid directly. We're not keeping a supplier invoice for bank fees. So Solar Motor Fuels 169, another one there. This one here, 20. Keep going. In case insurance, we've entered that. That was a check. Again, bank fees. Explain that. These are receipts. We're not looking at receipts. Solar Motor Fuels, another one there. 5th July. We got it there, so we paid that one off. Oops, sorry, wrong amount. 169.20. We've entered that one. As you can see the check numbers. We've entered that one. Bank fees we're not entering, and we've got one last payment there to Solar Fuels 171.55. Yeah. So those are all the payments we've done to our suppliers who we had listed out on our trade creditors listing or purchase invoice listing here. And as you can see, we paid them a total of 14,849 pence, and the two amounts outstanding: stationers £34 and an invoice of Bits and Bytes 5,875. The total amount is 5,909. Okay, so if your boss came to ask you how much do we owe our suppliers, you quickly come to this sheet and say, yeah, we owe them £5,909, 8 pence, and you got the workings and proof for it. So let's go back to the chapter that we're working on, which is chapter 6, and just go briefly through the steps. So we've done the first one using the checkbook stubs, and we filled in the paid amount. That's step 2. We've gone through the bank statement and filled out the paid amount. So that's good. We've completed the outstanding column. In this case, Excel helped us because we've got a formula there. And then we've totaled up the amounts down here. Yeah, so we've completed basically chapter 6. So I'm going to talk a little bit more about what it is you're seeing here. This, as we alluded to, is a trade creditors balance, showing you the total amount that you owe your trade creditors. They're called trade creditors because they're persons or businesses that you end up owing money to because in the process of your trading or your business trading with them, i.e. buying goods and services from them for your trade. This is different from a bank loan creditor. So those in accounting, we try to keep those separate. And the more accounts you do, you see trade creditors a different type of creditor. And they're the main creditor of businesses because businesses have to buy things from other people in order to operate. So in our little business, we've done for the whole year a few invoices. This is easy for anybody to understand what's gone on, but you can imagine for a large business there'll be thousands of invoices over the year and hundreds of suppliers or trade creditors. You can't have a list like this, it would be too difficult to look through. So like they do on sales ledger in big companies, when it comes to suppliers and trade creditors, the business will have an account for each supplier, and in that supplier's account they will have the purchase invoices that they receive from them and the amounts that they pay to those suppliers to pay down the account that the amount that they owe. And all these supply accounts are kept in one place, in one book. Traditionally, when accounting was done on paper, they had a book called a ledger, so it would be called a trade creditors ledger, or there are many other words for it. Purchase ledger, because it shows your purchases, or bought ledger, because you've been buying things from them. Or if you're in America, it's called accounts payable balance or ledger. So it's same thing but different words, because people look at it for different things. So I'm going to show you briefly what a purchase ledger looks like in the traditional T format accounts. So this is shown here on there, the last chapter, last appendix there, purchase ledger. So I've got some brief notes about purchase ledger and the history of them and how companies use them or softwares use them. But you can see for like the first supplier here, Stationer ETC Incorporated, you've got the invoice that we received from them, £34. We haven't paid them anything. We're closing off the account at the end of the year, so we're starting the new year. So traditionally you'd close off that account and bring any balances down to the new year. So the way you do it, the two balances on both sides need to be equal, and to get this side to balance, you do a carry down balance here. So it's £34 and 8p, similar to what we got. If you look at our simple listing here, it's there. Look at another one with a bit more stuff going on. So here, bits and bytes unlimited. So you can see again in our traditional T format, they're called T accounts because of this main line here and this middle line separating your credits and your debits. So as the invoices came in, they've been entered here. It would look like this, so the amounts that we now owe this particular supplier, credits, and that is amounts we're going to pay out. And then when we pay them, who obviously has to be the opposite of credit, we'll debit their account with a check. So we pay them 2 checks, 5875 and that amount, and that leaves a balance to carry down when we close off the year, 3,000, a balance to carry down of 5,875. Yeah, and to close off these accounts in the old way using paper, you total up both columns and you'll always find which is the bigger one, and then the difference would be entered on the side with the least amount, and it would be called the balance to carry down. It's a bit of mathematics, but you can do this for yourself to understand it. Now, accounting software can present to you your suppliers' accounts in this format, and sometimes they have different formats, and I'll show you different formats of presenting accounts in chapter 10 when I talk a bit more about the double entry system of accounting. So yeah, that is it. That is purchase invoices to be paid off, or as we're calling them now, trade creditors. I hope you've enjoyed this chapter, and I look forward to seeing you on the next chapter where we'll be talking about VAT. Thank you.